Hello, and welcome to IMG Leading Insights. My name is Zamazulu Zulu. Today's topic for this session is Yielding Influence, Females Shaping Fixed Income in South Africa. And I must say, I'm actually quite excited about this particular session because it definitely is a rare sight in our industry to have an all-female panel discussion. So, ladies, welcome, and I'm looking forward to our conversation. And let me quickly introduce you. So we've got Corinne Cordier, who is a credit analyst at Visio Fund Managers. We have Alida Malherbe, who is an investment analyst at Granite Asset Management. And then we have Pooja Tana, who's the head of fixed income at Perpetua Investment Managers. Welcome, ladies.
Thanks, Emma.
It's good to see you.
Good to be here.
All right, so let's maybe kick off with a macro discussion, just to kind of set the scene before we get going and unpack the portfolios that you are involved in. There's clearly been a lot happening this year, macro-wise, but I think of late in this, particularly this past third quarter, ending September, we finally had this Fed cut that I think the market had been anticipating for a very long time. 50 basis points, I think maybe it was a little bit more than what some commentators were expecting. But be as it may, it has now happened. Corinne, let me maybe start off with you. We've definitely seen a lot more developed countries, maybe except for Japan, for example, cutting rates this year. Are you expecting a similar trend for the next 12 months? And if so, what range of cuts are you expecting for the rest of the next 12 months?
I think it's difficult to say exactly what will happen because globally there's a lot of uncertainty. If we look at the US, we have elections coming up. I think that will be a big driver. Then Middle East, I don't have to say what's going on there. There's a lot of uncertainty there, and whether it can escalate or not, I think it's already at a point where a lot of us are worried. I think it will have a big global impact, but also, locally, fuel prices and. So I agree with you. The 50 basis points by the Fed, I wouldn't say it's too much because I wouldn't dare question the Fed, but I do think they will be cautious going forward. Given the data we see now in October with the employment was a very, very strong report. And then CPI, it's just very clear that, inflation is dying, but it's not dead. And so I think from a US perspective, they will trade very cautiously in November. I think back to South Africa, I have huge amounts of respect for the SARB because they had, the runway to cut 50 and they went with 25. Yeah. So I have huge respect for that.
Okay, we won't go into South Africa just yet because I just want us to finish with the global macro environment. But thank you for sharing your views on the interest rate in the US market. Alida, let me maybe come to you now. So there have been some commentators in the market anticipating a recession in the US specifically, and yet we still see fairly robust economic activity. What are Granite's view on this? Are you anticipating a recession in the US at all?
Look, I think it's probably important to emphasize from the outset that we don't attempt to make economic forecasts or predictions. We don't feel that we are in any way better placed than the economists whose specialist expertise we rely on. So we rather try to look at what the market is anticipating, what the market is pricing in, and how this may feed through to our portfolios. Currently, from what we're seeing, the market is still quite balanced in whether it expects a recession or not. And I think what we can probably take away from the Fed's recent comments and actions is that given its dual mandate to promote full employment as well as price stability, as inflation is broadly moving in the right direction, it appears that the Fed's emphasis is more on the consumer side. The US consumer has proved rather robust to date. So we're watching it quite carefully. We don't have a specific view either way. Rather, we'll just monitor the data as it comes out and see how that plays into how we position our portfolios.
All right. Okay, that makes sense. Thank you for that. Puja, let me bring you now into the conversation. I suppose one big surprise in the third quarter this year was the announcement of China's stimulus package. And I mean, do you believe it was sufficient? Is it going to result in a sustainable outcome for the market? What are your views on the Chinese economy in general?
Okay, so the two questions that come to mind immediately with China is that, firstly, they need to kickstart inflation. So you need a reflation scenario. So the question you need to ask, there's two questions you need to ask. One is that, are the stimulus measures enough to kickstart reflation? And secondly, are they going to achieve their growth target of 5%? The answer to that, and this is very interesting because the market was pricing in quite a hefty stimulus package coming into the weekend, right? So they were pricing in about 2 to 3 trillion Chinese yuan. And I must say the governor did disappoint. Like, he's not put a tag to this fiscal package. I'll tell you the wording, and this has come across a lot of the commentators and a lot of the economists that I've been listening to, is that the fact that Beijing is actually embarking on stimulus measures is actually quite important in of itself, because previously they refused to. It was part of the Chinese belief that you don't solve a problem immediately with monetary injection, or there's this belief, and actually need to go read up that statement, but it's a very interesting statement. But what they've done is they've gone backwards, and they've said, actually, you know what, we are going to inject the economy with stimulus. So that turnaround is very key. That's why the markets are very excited. And I think in the upcoming months, we need to we want a fiscal tag to the stimulus. So I think that's what the markets are looking for, a tag or a number, a specific number to this stimulus.
Okay. No, that's very interesting, because I think it definitely came as a surprise to everybody. And it was interesting to see how that particular announcement impacted the equity markets as well. So I suppose it's one to watch, definitely one to watch. And just out of curiosity, in the global space, we've now seen the likes of the Central Bank of Brazil, for example, looking at increasing rates. And similarly with the Bank of Japan, so there's a bit more tightening coming in those markets. Do any of your portfolios, we'll get into a portfolio positioning discussion a little later on, but while we're on this particular topic about looking at global, do any of your portfolios have exposure to any of these emerging markets, including Japan? And Japan obviously is a developer, but yes. Any of those?
Can I?
Yes, yeah, please go for it.
Okay, it's so interesting because I find these two countries so fascinating. India and Brazil are two countries that I'm actually watching, right? So now if you go across globally, look at the yields globally, China and Japan, you almost kick out. They're too low, right? But now you're going into interesting spaces. The US have pretty much priced in their cutting cycle, I think, especially 2-year treasuries. So you almost want to unwind the position if you did have it. And what's interesting out there, Brazil is hiking interest rates and the inflation profile is actually quite stagnant. So it's so fascinating to me that the inflation, if you look at the inflation forecast, it's not spiking up. They don't need to hike rates immediately. But it's an interesting thing. It's a political play because the president is going to appoint a new governor, and I think this is the central bank's way of saying, this is declaring their own independence. So Brazil's definitely one I'm watching. Also, what's nice is that the fiscal metrics are very similar to South Africa. So it's very interesting to watch the two countries, especially since we're now in a cutting cycle and our yields have rallied north of 150 basis points. So Brazil's actually, if you screen EM, and if I was an EM trader sitting with a basket of emerging market currencies, Brazil's starting to look very, very, very good, while South Africa's starting to look a little bit more expensive. And if you go into India, India is another country that I'm looking at that's fascinating. And the Reserve Bank of India have just come out and signaled a neutral policy stance. Which basically means they're now ready to embark on a cutting cycle. Added to that is that the Indian bonds have now been included in the WIPI index, the JP Morgan Emerging Markets Index, and their current weighting stands at 4%. They have to get to 10% by March 2025. So I almost feel like there's a natural sort of support for Indian bonds, So that's something that I'm actually, that's something very interesting and something to watch out for, because I'm actually long-term very positive in India.
Okay, that's actually quite an interesting investment opportunity. Okay, cool. No, thank you so much for sharing that. All right, so let's bring it back home now. So, Corinne, earlier you mentioned the South African Reserve Bank cutting by 25 basis points. Did you feel that was a bit too low? Were you hoping for a slightly bigger cut? especially since we've been waiting. And another question added onto that is, was it necessary to maybe wait for the Fed to cut first before we could cut, or could we have cut before the Fed? Just out of curiosity.
No, I don't. Your last question, I don't see any reason why we couldn't cut first. I think to the governor's point is, if inflation is at the target level, the mid-target level at 4.5, and that's sustainable, then they can cut. So I'm personally happy with the 25 basis points. I didn't feel it was too much. If there was none, I would have been very disappointed. And I think a lot of consumers out there would have also been disappointed. So no, I think a 25 was reasonable. I prefer a cautious approach, which I think they are taking. So no, I think it was on point.
Okay. And Alida, from Granite's perspective, how many more cuts are you expecting?
So once again, we're not trying to forecast, but we look at what the market's pricing in. So currently the market's pricing in an additional 1% in cuts towards the end of next year. And those are expected to be in incremental 25 basis points cuts. We believe that this is a reasonable expectation. An example of how, for example, it would play into our positioning, just so that you can explain how we think about things, or understand how we think about things, is that we believe, for example, that nominal government bonds are largely pricing in anticipated rate hikes at the moment, whereas inflation linkers aren't quite pricing these in to the same extent, and are not pricing in the same positive sentiment towards South Africa or confidence in our economy following the formation of the GNU. So incrementally, we have been favouring linkers over nominals. And that's based on looking what the market's pricing in, what we believe has been a reasonable expectation that's already priced into government bonds, and just adapting our thinking around that.
Okay, great. All right. That is something that we will touch on a little later, but at least you kind of set the scene in terms of your views with regards to nominal versus inflation-linked bonds. So another big event that we're all waiting for in our market at the end of this month, October, is the medium-term budget policy statement. So Pooja, let me come back to you. Any particular expectations with regards to that policy statement?
Look, I recently attended the Morgan Stanley conference, and the Deputy Finance Minister was speaking. And look, he was reiterating over and over and over again that they're definitely sticking to fiscal prudence. They're going to stick to their fiscal envelope, which means, and they're targeting a debt to GDP of 70% in 10 years' time. So what I do...
Sorry for that.
I know.
I think, sorry, Pooja, for that. I'm laughing because our view is that on the long end of the curve, we feel it's already pricing about like 65%.
Yes, 100%.
So
that's why I'm laughing.
That comment of 70% is quite fascinating.
Look, it's their long-term target, so it's commendable that it's the long. But I agree with you. The South African government bond curve at the moment is pricing below 70% already of debt to GDP. So that's how much good news has already been priced into the SAGB curve. So the back end of the curve is super expensive, as far as I'm concerned. But just to answer your question, we are going to look for any Transnet bailouts, because he very specifically said no bailouts, no handouts. So I definitely want to see what he's going to do about that. We're looking at more maybe extended social grants. So we want to see if there's more in play over there. We'll watch out for that. We obviously want to see how they're planning to get debt to GDP back to 70% in a decade. Personally, I think that's too long to take to get debt to GDP. But you have to be realistic. We have problems. We have to solve those problems. And a lot of our problems are SOEs. And all our SOEs need money. It was at the Morgan Stanley conference, there were so many ministers presenting. And it was so funny. At the end of every single speech, they were like, oh, we just need more money. We just need more budget. And then the Deputy Finance Minister stands up and he's like, no more handouts, no bailouts. So that's what it's going to be. It's going to be a tug of war. So yes, I think it's going to be a prudent budget. I think they want it to be a prudent budget. But yeah, we will see. We'll wait and see what the particulars are going to be.
Okay, no, thanks for sharing your insights on that. I suppose we just need to wait and see what transpires at the end of the month.
I can maybe, sorry, let me go.
No, I'm just saying on the Transnet point, that obviously is the elephant in the room, and a chunky one at that. But at a media conference recently, the Duncan Peterson from National Treasury mentioned that they are working on some sort of blended finance model with Transnet. And he intimated that some detail would be made available in the medium-term budget policy statement. So that's really what we'll be keeping quite a close eye on. We're hoping for some further clarity around that, because that's really where we need
Comfort.
Yes, comfort, and we need this turnaround to be accelerated.
Oh, for sure. Corinne, was there something that you wanted to comment on that?
Yeah, I would just like to add, I think, to the medium-term budget. So, yes, Transnet is a concern, but like we just said, it's not the only SOE that's in trouble. If you look at Post Office, SABC, so, and then aside from just like, these SOEs that are failing, if I can call it that, because it's exactly what it is, they're failing. We have wage bills that has been paused, increase has been paused for 2 years now. Those negotiations are back on the table. Government say 3%, that was declined. So I think that will definitely have some pressure on the fiscal consolidation. And then, apart from that, I think one of the things that we are most curious about is if there will be any mention about the lowering of the CPI target. So currently between 3 to 6%, and I'm very curious to see if there will be mention of it. I think our base case, it will just be we're in consultations and so on. But I do think that is something that we need to take into consideration going forward. Because in my head, and you did ask me earlier about our view of local repo rates. So we're currently at 8%. Pre-COVID, we had 6.5%, 6.5, 6.75. But our steady state for repo is 7%. So that's 100 basis points. So already that's just signaling that it won't be as deep. And if the CPI range is lowered, it will make up a very interesting case.
Oh, for sure.
Yeah.
For sure.
So it will definitely, 30 October, I think, is a big day in our markets.
Okay, no, thank you so much for sharing all your views on that particular topic. But as I say, we'll just have to wait and see.
Yes.
All right, so now let's move on to the portfolios. I'll start off with you, Alida. So the Granite BCI multi-income portfolio. Can you just please share what is the investment objective of the fund, the strategy that you apply in managing the portfolio? Let's start with those two.
So our formal objective is to deliver benchmark beating returns with a benchmark of STEFI plus 1%. But what we're really trying to achieve is not necessarily to be the best performing fund in the category over all periods or to shoot the lights out in any particular period. We aim to deliver consistent, reliable returns over longer time periods. The strategy that we employ is a flexible fixed income mandate. So we're able to invest across the fixed income universe, as well as in asset classes such as preference shares and listed property. So that will be to a more limited extent, given the risk profile of the fund. And I think what we're really aiming to do is, and what we've built our track record in, is trying to be nimble and flexible in allocating between all the asset classes available at our disposal in order to target the best risk-adjusted returns.
Okay, fabulous. Fuja, I know your fund is most probably the youngest of the three represented on the stage. You launched the Perpetua SCI Flexible Fixed Interest Fund in mid-March this year.
Yes.
What is the objective of the fund and the investment strategy that you apply?
Okay, so the objective is, and I'll start with the benchmark because it's DEFI times 120%, but what it tells you is that we're coming from an absolute growth return mindset. this is not a typical tactical asset allocation strategy. We're starting with what yield we want to target, and then we formulate going up from that. So we really are targeting an absolute return objective there. In terms of our strategy, it's a flexible fixed income fund. And I loved what my client said to me when he seeded the strategy. He said to me, Pooja, use your entire toolkit. You are the fixed income PM, use your entire toolkit. And now my background is derivatives. So this is quite exciting for me. So what we do is that we can go local and global, and which is why I extensively research global regions as well, because it's a huge part of the flexible fixed income portfolio. And then locally, we obviously invest in all the different asset classes, including derivatives. And on top of all of that, we overlay it with very active currency management, utilizing options and derivatives as well. So that would be the key differentiators as well, because that's where my expertise of running hedge funds, running derivative desks come into play as well. Just having that knowledge and being able to implement it within the fund and generate excess alpha.
So your fund can also have global. You've just mentioned that,
Yes.
and you're using currency hedging, because I was actually going to ask. I mean, especially in a fixed income world, every basis points counts. So with the currency being as volatile as it is, at least I'm glad to hear that you are utilizing hedging strategies for those currency fluctuations. Do you have a limit on your global exposure for the fund?
Yeah, I mean, it would come from our tactical asset allocation, or it would be Reg 28 basically. Really that's your limit. So
it could go as high as 45%.
it could, but I don't think I would. Although I must say, I think my fixed income fund has the largest global exposure at the moment. I believe you said that to me once.
At some point, yes, I did
Yes.
pick that up. Yes,
Yeah.
relative to peers.
Yeah, but look, I do hedge the currency exposure, but I'm very active about it. And I'm very comfortable with the currency exposure. And we make calls on the currency exposure as well. We will never not hedge the currency exposure, but the way we hedge it is very key to the management of the strategy, because you've got such a huge global component, and currency is part of that. You want to generate alpha out of the currency exposure. So, but in order to do that, you need to have an in-depth knowledge of what the best instruments are available to manage that currency exposure. And that's what we do really well at the picture.
Okay, fabulous. Alida, sorry, let me just come back to you, because we didn't unpack the global piece in the multi-income portfolio.
Yeah.
I see that it can have offshore. Do you have a limit for that part of the
Once
portfolio?
again, it would be Reg 28 dependent. At the moment, our exposure is at about 12%, but we hedge out all currency exposure. So we don't take currency exposure at all. And that's also just to manage volatility in the fund, given the investors that we're targeting.
Okay, fabulous. Okay, so at least we've established that. All right, then, Corinne, let me come to you. So the Visio BCI Unconstrained Fixed Interest Fund was actually launched the same day as the Granite Multi-Income Fund. They were actually launched on exactly the same day back in 2016. So a good 8 and a bit year track record. What would you say is the objective of the fund and the investment strategy that you apply?
Yeah, so actually the fund has a 12-year track record, because before that it was a segregated mandate. So it has only been in the category for 8 years, but it has a 12-year track record. So when we look at the fund and we look at the performance, and I want to say the outperformance, we do look at the full 12-year period. But I think something that I picked up here that's very interesting, and you did mention to me that each of us will have something different. And I think when it comes to our approach to currency derivatives, or just currency in general, it's very different. With Pooja, use it to generate alpha. Alida say they don't take any currency exposure. They convert everything back to ZAR. Is we do use currency hedging, but for a very different reason. So first of all, when we use it, we don't look at it as a singular position. Okay, so like Pooja would look at it as a singular position, right? But we would rather be like, if the currency or currency futures do good, then our local market will probably bonds will sell off. So those two will kind of balance each other out. So essentially it's a hedge, it's protection. So we do take currency hedges. We don't make calls on the currency at all. To get back to your original question, in terms of the fund's objective and the strategy we follow, so capital preservation is very important to us. We do not intend to make our clients rich overnight. We want to protect their hard-earned money, protect it and grow it over time. And the way we do that is because we're in the multi-asset income category, we do have access, similar to Alida said, we have access to a range of fixed income assets. And we use those to protect each other. And then in general, we do also keep the fund at a very, healthy cash balance so that we can take advantage of opportunities as they come along. And then in terms of strategy, again, very similar to Alida, we do not forecast. And there's reasons for it. I feel like when you have a model with the right set of assumptions, you can make it look the way you want to make it look, and have the outcome you want. So we do not forecast. We do not take concentrated bets. We move slow and steady. And that has proven to work for us. And I must say, I cannot take credit. Jonathan is a great manager, and he's been doing this for 12 years. So he knows the fund in and out. And maybe that's one of the key differentiators, or it is, not maybe, it is the key differentiator, is having Jonathan looking after the fund for 12 years now. And that's quite rare to have that long track record with a fund and the same PM.
Okay, great. Thank you, ladies, for giving us that overview. It's very clear to me that your objectives are maybe similar. You're all trying to generate a cash-beating return at the end of the day, but the way you go about it is different, with a bit of, hedging here and there, maybe utilizing more asset allocation for a hedging perspective, but you're all running fairly conservatively managed portfolios, so none of you are swinging for the fences, in how you manage your portfolios. The one thing that none of you have actually touched on is duration. How do you manage the duration in your portfolios? Maybe let me ask you this. Do you have a duration limit specifically in terms of the mandate of your portfolios? From a visual perspective, is there a limit?
Yes. So in history, we have not gone above 4.8. Okay. I think currently we're sitting at 3.2, and we're comfortable with that. And that's why I mentioned we keep a very healthy cash balance in, so that we can move the duration. Over the last quarter, as I mentioned earlier, the long end is very expensive based on our fair value. And, so we're staying out of it, the long end. So we're not looking to increase duration currently. Okay. Are we decreasing? We're staying put, seeing what happens the 30th.
Okay, maybe just for context, for the benefit of our viewers watching this, where's the All-B limit duration at the moment? Is it closer to 6? Is it 7? Where is it? Just out of interest.
Between 5.7 to 5.8.
Okay, so it's just under 6.
It is around there. Right?
Yeah, it's around 6.
Okay, so it's around about 6. And you said in terms of your history of the fund, the highest you got to was 4.8.
Yes, and
okay, great.
Sorry, I want to blab on about it because if you look over the 12 years, we've underperformed the All-B, but we so close. And to think that we can take so much less risk to kind of get to that return profile, I think is extraordinary. And now currently we just on the 3-month, over this third quarter, we did very, very well in the fund. And we had we're sitting at 3.2 modified duration. So
there you go. Okay. All right. So I think it's becoming very clear. Visio, unconstrained fixed interest, big theme for this portfolio is to generate bond-like returns at significantly less risk.
100%, yes.
Fabulous. Alida, from a Granite's perspective, is there a duration limit for the multi-income fund?
So in terms of duration, our limit is far lower at 2, and that's primarily to manage volatility in the fund. Currently, it's far lower, given that we've held back a bit on our government bond exposure, so we're sitting at around 1.3, 1.4 at the moment. But we view duration as part of our toolkit. So we'll utilize duration when we feel it makes sense. but it will never be a binary bet. It's one of the tools we use in generating our returns.
All right, no, that makes sense. Pooja, from your fund's perspective, do you have a duration limit?
We do. I think we've got up to 5 years. But I must say, again, as Alida said, we use duration as part of our toolkit. And I've always found, up until recently, I've always found the back-end bonds quite expensive. So we've always been shorter duration, a lot shorter duration than most of our peers, and definitely against the Orbi. We recently extended duration, but again, I feel like the back end is expensive, so we're currently reducing that. Not even just locally, globally as well. So we're unwinding. I'm very uncomfortable with the back end of the US Treasury curve as well, depending on what happens with the elections and the potential fiscal impact. I think that the back end of the curve could hurt a little bit. So again, the theme for all our funds, all the fixed income funds, is that we are reducing duration, but it's always been that. I've always, like, when you look at it from a risk-adjusted perspective and you look at what other instruments are out there, I find it very difficult to justify adding duration into the mix just at the moment.
Okay, cool. All right, thanks, ladies, for unpacking that. So I want to show you a slide. These are your views. It's the first time you're seeing your views relative to your competitors. I had asked you to just share your views on the various fixed income asset classes, and this was the outcome. So I only just want us to really focus on 3 of those that I thought were quite interesting. Firstly, the views on SA government bonds in particular, and even global bonds. So Pooja and Alida, I actually just wanted to, I suppose you've answered some of this in some of your previous answers, but maybe if you can just kind of give us a nice summary. Perpetua bullish on SA government bonds. Can you maybe just unpack that, Pooja? Is it specific types of particular area on the curve that you prefer? You sort of mentioned that, the back end maybe not as attractive. And then what types of bonds are we looking at? Are you talking about nominal government bonds? Are we looking at maybe inflation-linked bonds in that sector? If you can maybe just give us a bit more color on that.
Okay, firstly, I just want to say we're bullish, but that was leading up into the year.
Oh, okay. All right.
I would almost agree with the leader. We're neutral bullish at the moment.
Okay.
But why we said bullish is because it does reflect our positioning. We are overweight South African government bonds. And I am quite constructive South Africa because we are getting the tailwinds from the cutting cycles globally. So that added to the newly formed GNU and the positive rhetoric that's coming out, even though we may not see it at ground level, and we know there's a lot of issues internally. When you're trading South Africa on a global basis or a global platform, you're just looking at the surface. And on the surface, our political issues have become very minimal, or there's very minimal risk associated with SA politics. As a result, we're quite attractive. So in terms of South African government bonds, we're quite constructive because if you look at, obviously, the positive story from the GNU and SA politics and just the way the global markets view South Africa. And also the fact that the foreign ownership is currently, at the end of August, we're sitting at 24.6% versus a high in March 2018 of 42.6%. So we have not yet seen the inflows from foreigners that we would have expected to see. And given that most global banks are in an easing trajectory, you would expect those funds to flow somewhere. And South Africa still looks attractive. I mean, just based on, if you just look at it on a fiscal basis, fiscal metrics, economic metrics, the fact that our SARB is actually quite stable. We've got a great central bank and a very well-respected SARB governor. So the story is constructive as long as we have the tailwinds. Obviously, there's simmering geopolitical tensions. The US elections are going to be massive in determining everything, So there's a lot of touch point factors, but if we just look at South Africa in isolation, we're quite constructive.
Okay, great.
No, sorry to interject. I mean, that's broadly our view as well. it's hard to be as positive as we were leading into the elections, honestly. So there is that recency bias that filters in, but on a standalone basis, also just given the other alternatives available, we believe that on a risk-adjusted basis, government bonds continue to offer value, not as much as they did a few months ago, but also that there is the potential for the instruments to strengthen further from current levels based on potential tailwinds and accelerated reforms coming as a result of the GNU.
Yeah. Okay, fabulous. Alida, let me stay with you because the next asset class I want us to chat about is your view on property. Both local and offshore, you are bullish. Maybe just kind of take us through the investment case for the asset class, bearing in mind, the local property market has definitely been our best performing asset class year to date. Do you still believe that it has legs?
Yes, we do. So across the business, we're quite bullish on property, and we're fortunate that we're able to leverage quite a lot of research from our multi-asset team as well. And broadly, what it comes down to is that we believe that the downward cycle that we've experienced since COVID in an environment of very high interest rates has bottomed, we hope, or is very close to bottoming, depending on which pockets you look at, and is starting to turn. And if we look at property as an asset class over the course of history, it does tend to move in very long and broad cycles. So for us, it's a recognition that the cycle is starting to turn. That being said, we are very selective on the counters we invest in. So based not only on the attractiveness of the property portfolio, but with particular emphasis on balance sheet strength. Should we see the turn that we're hoping for and that we're starting to see evidence of playing out over a longer period than we expect. So we really make sure that we invest in the companies that we believe have very strong balance sheets and that can weather the possibility, for example, of interest rates remaining higher for longer than we expect.
Okay. Any examples specifically on the property side that you can share?
Yeah, sure. So in the multi-income fund, currently our property exposure is about 4%. As I mentioned earlier, this will always be quite low, just given the mandate of the fund. And it will also be diversified across individual companies. Locally, we're invested in Growthpoint and SA Corporate. And globally, we're invested in Unibail and in Derwent. And once again, these are also exposures that our multi-asset class funds hold, just to a larger degree.
Okay, great. Corinne, I want to come to you now. Your Visio's view on SA Cash, I found quite interesting. But then referring back to something that you mentioned earlier when you were explaining the investment strategy for the Visio Unconstrained Fixed Interest Fund, you did mention the importance of utilizing cash, sort of kind of your dry powder, as and when opportunities arise, and at least you've got cash available to, participate in those opportunities that come around. But I was just curious, if our view is that we are in a declining interest rate environment, I'm just trying to make sense of the view, being bullish on cash. How does that tie up when we know that we are moving into a declining interest rate environment?
Okay, so if you think of a money market, they invest in short-dated instruments. So you have your FRNs, your floating rate notes, your NCDs and TBs and so on. So if you think most of them are linked to, say, a 3-month reset, okay? So those resets has not come up yet, okay? So that's why there's always a lag with money markets. So we've cut, SARB has now cut 25 basis points, but we don't see that lag or that decline in money markets immediately. There is usually a 3-month lag, and that's linked to the resetting of the floating rate notes and so on. And then if your TBs expire, you have to reinvest them and so on and so on and so on. So currently, we think cash is still offering decent levels. And I think the counter question that is, what do you do with the cash? And I think this kind of also ties in with our view on SA corporate bonds is we do not feel that there's enough risk compensation in there at the current spreads. So yes, we keep cash because we need to move duration. As I mentioned earlier, we want to be able to take advantage of opportunities as they come along. But we're not losing out. We're still, meeting our CV times 1.25 with this cash level. So we're comfortable with the position.
Okay, great. No, thank you for giving us that insight, because I was just a bit curious as to your views on that, particularly because of the current interest rate environment we find ourselves in. All right. Now, an interesting thing that is usually said in our market is if you are a bigger player in the fixed income space, it's better. You have access to more and exciting opportunities compared to when you're a smaller player, you don't have that exposure. In your view, and bearing in mind your portfolios, okay, they're different levels in terms of assets under management at the moment, but do you believe there are any benefits or maybe any disadvantages of running smaller portfolios? Because the reason I'm asking this is all your portfolios are competing against some really massive funds in the category as well as brands in the industry. So you're all trying to fight for your fair market share of the fixed income assets that are out there. So for somebody watching this who is maybe considering making some changes to their fixed income lineup, and they're thinking, okay, these are smaller players in the fixed income space, what would you say are let's just be honest, if there are challenges, mention them, but I think maybe let's just focus more on the opportunities, because I find that if you are a smaller player in the equity space, you always say, okay, you're nimble, you can play in various sectors of the market, like the mid and small caps that maybe some of the larger players can't necessarily play in a meaningful manner. Is it necessarily the same in the fixed income space? Alida, let me start with you.
Yes, I do believe that there is some alignment between that and the fixed income space. I think that being smaller allows you to be quicker, to be more nimble. It also means that the investments you do make have a larger impact on your overall return. So there is a certain level you have to meet to be offered access to opportunities. So I think if you're very small, it can be more difficult to get access to those opportunities. But once you reach sort of a mid-level, I would say, you actually are afforded access to a lot of opportunities that might not make sense for bigger players. As an example, we have built quite a strong credit capability in our fund, so we're quite known in the market for our credit function. And as a result, we get approached by capital markets teams and debt originators with opportunities, be it private placements or unlisted opportunities that wouldn't move the needle for a big player, but give us the potential to earn a very attractive spread on an investment size that makes sense for our clients.
Okay, great. That's actually comforting to hear, because you sometimes get this impression that if you're a smaller player in the fixed income space, you will typically get excluded from these exciting opportunities. Because I remember back in the day, a lot of the corporates would actually approach the big houses and they would curate something specifically for their requirements. So it's interesting to see how things have changed. Maybe
it's changed. That definitely does still happen.
Yes.
As an example, the recent private placements by Transnet at very attractive spreads did definitely not come across our desks, unfortunately. So there definitely is a lot of that still happens.
Okay.
But I think it does go both ways.
Okay, great. All right, then I think just in closing, the last couple of minutes that we have left, I thought I can't let this opportunity go past us, because we are 3 ladies in studio with me, which is fabulous. Let's just maybe have a quick check-in, from a women in finance perspective, because I still believe, gender diversity in our industry is nowhere near where it could be and where it should be. So I thought it would be worthwhile at this point in our conversation Yes, we've had an important conversation up until now, but I think this is even more important, is to just maybe let each of you share your journeys in this space. How did you get into it? What are you enjoying about doing what you do, in the fixed income space? And any words of wisdom that you'd like to share to maybe even encourage other women, who are considering career options, why they should consider asset management or investment management. Pooja, let me start with you.
Okay, so you want me to share my journey?
Oh, just high level in the last few minutes.
Very long journey. I started as a grad at Nedbank, and I straight away got into the dealing room. And I started on my second year on the job, I was in the sales team, and the third year I moved over to the trading team. And very quickly, I must say I had a great mentor and a great manager. And he moved on to become the head of the area, and he gave me this option, and he said, Pooja, I was the best qualified individual. I was the youngest, but I was the best qualified individual to run the book, the swaps book. It was a very complicated book because everything landed up in the swaps book. And he said to me, and I remember this conversation because he said to me, Pooja, you've got two options here. No one's going to judge you. You can continue doing what you're doing. We'll hire a senior person and we'll let them run the desk and you report into the senior person. Or you can take that role and see what you can make of it. And he said you could explode, your career could explode, or you could just go down in flames. And he was quite candid about it. And I already knew what I was facing. It was a largely male-dominated environment, and I was very young, and I was a young female. Nobody thought I could do it or could do it. And that first year was very difficult, but I took that opportunity. There was no ways I was not going to take that opportunity. I took that opportunity, and very rough year, but suffice to say, I proved everyone wrong in that room. And I went on to have probably one of the best books. By the time I left, it was probably one of the best, most profitable books in the room. One of the largest books in the room. So it was a great, I had a great mentor. That's a key thing. I actually want to say when I take you through this journey, it's very important to have a mentor or a backer or a very good manager, because I had a very good backer, and they gave me these options all the way. And then I moved on to Standard Chartered, where I built up their fixed income trading business here locally and globally. And that was a very interesting chat. I don't believe my career would have ended up the same way if I had not gone to Standard Chartered Bank. It was 3 years of intense business building, but it left me with such valuable skills. Working for a global bank is never easy. It's incredibly tough on your hours. Even as a mom, I had just had my child, and I got pregnant with my second one. And as a mom, it's very difficult. So after my second child, I decided I needed to do something different. And then this opportunity in asset management came along. And it was a great bridge between sell side and buy side to manage hedge funds at Old Mutual Investment Group, which is where I went. And I thought that was a great bridge because I'm so used to trading on a daily basis. It made a lot of sense for me to come over to Old Mutual Investment Group and manage the hedge funds. And then a year ago, Delphine and I spoke, and the rest is history. It's such an exciting opportunity. I'm building a fixed income capability at Perpetua from the ground up. And it is, and also, you know what I love about Perpetua? It's a woman-led firm. Love working with Delphine and the opportunities, because I started, as I went through this journey of mine, and needless to say, I always had grads coming and working for me, and they were always female grads. Mm-hmm. And they all turned out to be traders. So I did not do it intentionally, but it just happened. They would see me, the only female trader in the room, and say, how are you doing it? And I'd be, come on, come learn. Come sit with me for a year. And they did that. And I'm actually happy to say one's an options trader, one's a basis swaps trader. Very, and they keep in touch with me all the time. So that's great. But I've become very passionate about women in business and women in finance. And I do a lot, I'm doing a lot of mentoring. I'm doing a lot of I do a lot of talks. I am very passionate about that. And that's something Delphine and I are very aligned on. And so it's been amazing at Perpetua to have that opportunity. And it's like a free opportunity. When you're at a larger corporate, it is a little bit difficult. But a place like Perpetua, where it's woman-led and Delphine is so passionate about it, it makes a massive difference. So I feel coming to Perpetua was possibly the best career move, but personally and professionally.
Oh, that's fantastic. Now, thank you so much for sharing your journey. Corinne, let's come to you, your story.
I almost want to
Briefly.
clap hands for example, but I think you have a few years on me, so please, you know.
I give that a lot of years.
I think, well, I want to stick to Pooja first because there's a few things that she said I think that resonates with me, and I'm glad that you also pointed out the tough times, because I think as females, we, you know, and especially in times of social media, we look at like your Instagram and your Facebook and it's just portrayed all the good, but it is actually quite hard when you in finance, and especially because it's a male-dominated industry. And I think I would imagine all your stories you would have about, you know, raising children, because I can imagine it's quite difficult. But yes, being real about it is so important, so that we can kind of be like, build that resilience, not in just ourselves, but also, you know, for others, and show that it's not always a straight and narrow path. Like, for example, my journey, I didn't step out of university straight into a grad program. I did it completely different. But I'm sitting here, so it's fine, you know, so it's not a straight path. So I think my advice to anybody would be, you know, if you're sitting there watching and you're about to finish university, you're not sure what to do, is it's fine not to know, you know, but mentoring, it is so important. Like, and I actually got my mentor quite late in my career. When I started at Prescient, one of the guys that worked there, and I must say he's quite old, is almost, he can be my grandfather, Rob Kiley. And he just, I think in a time where I didn't believe in myself, he really believed in me. And that for me was like career defining, you know, to have that support. And I think one of the things about mentoring is it's not just about giving advice, it's also about kind of giving an opportunity for others to grow, you know, opening that opportunity, exactly like your manager did, and say, Pooja, here's the opportunity for you to take over the book. So it's not just about advice, it's also about giving them the opportunity to grow.
Fantastic. And you, Alida?
Yeah, so I mean, I studied investment management, but I went on to complete my honours in journalism and a master's degree in communication. So it was a bit of a mixed bag for me, but I spent my career in financial services, initially focused on communication and investor relations. But similar to, I think, what the other panelists have shared is you do form key relationships in the working environment. And given that my role later comprised very close interaction with the investment team at the company I was previously based at, I was offered the opportunity to join Granite when it expanded the business to include its multi-asset offering, and to then change my focus to investment research. And once again, it was an opportunity that had me a little bit out of my comfort zone, but one in which a lot of people showed a lot of faith in me, and which I'm now pleased to say has led me to where I am. And I'm so happy doing what I'm doing. What is so great about Granite is that there's a particular emphasis placed on finding every person's sweet spot. So even if you are hired in a certain role, if you feel maybe you want to try a bit of that, then we're given that flexibility. And that's how I've found my way into fixed income, which I just have such a natural affinity for and an enjoyment for. And it is, I think it's important to take the time to build relationships, to make an effort to learn from others where the opportunity presents itself. And I mean, I think we all need to acknowledge that you do have to work hard. But I will just say it can feel quite intimidating from the outside. If you're young and you're looking at entering the world of investments. But if you end up at the right place, surrounded by the right people, it's completely the opposite. And it's an opportunity for continual learning, continual growth. No 2 days are ever the same. So if anyone feels that that might be a suitable career path for them, I would highly encourage them to look into it. And if anyone is based in Cape Town and wants to come to Granite for a coffee, our doors are always open. We chat to people all the time. So, the invitation stands.
Excellent, ladies. No, and thank you so much for being vulnerable, and sharing your stories, because I think we learn a lot from each other's stories. The common thread in all three of you is how you had mentors and sponsors who were very instrumental in shaping your career path. So may you continue to thrive in this fixed income space. And thank you very much for sharing all your insights around, the macro side of things, unpacking how your portfolios are positioned, explaining your views on various asset classes. So, and I really hope our viewers also enjoyed this segment. So thank you so much. And I suppose we just need to brace ourselves for this final stretch until the end of the year. Lots to come in the next few months. But thank you once again. And thank you so much to our viewers. We really hope you enjoyed this episode.